Good morning. It's Tuesday, the 7th of May, and this is Govindraj Ethiraj broadcasting and streaming from and headquartered in Mumbai, India's financial capital. Our top stories and themes for the day. The stock markets are flat as they weigh conflicting signals. Could that be the presiding theme in coming days? Well-known non-bank finance company IIFL Finance hit with a liquidity crunch after banks slow down lending following a Reserve Bank of India clampdown. Drought hit Australian farmers benefit from Indian pulses demand. And apprehension and optimism are both ruling high in the stock markets ahead of election results. What should you be doing?
This is a call report with Govindraj Ethiraj.
Optimism and apprehension in the stock markets. The markets are and will likely stay in a period of conflicting sentiments for a few weeks. Remember, we are on 7th May and the results of India's general elections are on June 4th. And of course, there are a few phases of polling still to go before that. And it is one of the hottest summers ever. And technically, summer is just about starting. Global cues were strong overnight on Monday and lifted the markets in early trade as they usually do before the momentum began fading as we went into trade during the day. As flat trading days go, yesterday must have been amongst the flattest. The BSE Sensex was up 17 points at 73,896, while the wider Nifty 50 was down 33 points at 22,443. So the Sensex closed up and the Nifty, which is the broader index, closed down. The BSE mid-cap and small-cap indices fell much more, declining about 1% each and was thus worse off than the benchmark indices. Now, a gauge we usually don't speak of is the volatility gauge or VIX. VIX is a volatility index which measures, as the name says, volatility in the stock market. So when VIX numbers are low, volatility is low, and the VIX number is high, then volatility is high, which is usually accompanied by some fear in the market. So the India VIX, which some also call the fear index, by the way, was up at 16.5, which is almost up 15%. Now, barely 2 weeks ago, the VIX was just under 10. That's on April 23rd. Now, volatility levels apparently rise amidst general elections, and a rising VIX level could also trigger some short-term bearishness, according to analysts quoted by Money Control. Of course, they also pointed out that VIX levels have risen historically to above 22 to 24 ahead of elections. So going from 11 to 16, as it did just now, is not a cause for major concern. But all of this definitely means that the markets will be or already are in the jittery zone for some time, as we referred to last week as well. So whatever your election predictions are, a certain degree of apprehension is bound to creep in as the days pass and we come closer to the results day. So let's put sentiment aside for a moment and pick up on how a biscuit company and a commercial vehicle company are reporting their demand and sales as well as outlook. Britannia Industries is trading now at a 52-week high after having jumped almost 9% on Monday thanks to expectations that demand will go up, particularly in rural India. Sales are still moving slowly, growing 3.1% for the quarter ended March 31st at about 4,000 crores, while net profit actually declined to about 537 crores. Annual sales up again only about 3.5% to about 16,500 crores. However, analysts at various brokerages are seeing gross margins as stable at around 45% according to the Mint, which means that some of the raw material prices, which could be wheat, could be coming down. But with monsoons predicted to be strong, the bets on rural demand or companies and stocks that are connected to and plugged into rural demand will surely look up. Elsewhere, Ashok Leyland, the Chennai-based truck maker, said that there is no indication of a downfall in their industry. From freight demand, freight rates, reduction in diesel prices, and sentiment of fleet owners, everything was looking positive, the company told Business Standard, adding that they actually saw a 10% growth in volumes in April. They also said there was no impact of elections on sales of trucks, which usually happens. And interestingly, Ashok Leyland says that while the industry is expecting a fall of around 4 to 7% this year, they were holding a more positive view, particularly if the months of May, June were to do well and therefore could end the year with a small growth. Now, the point, of course, is that it's tough to call a clear trend because some companies obviously do better than the rest at all times, which is why we're also talking about these companies. But it also does tell you that industry trends in different segments could do differently, and companies within that could do much better than the industry trends. An interesting data point from Wall Street, by the way, where, as you know, the wait for an interest rate cut by the Federal Reserve is now getting longer and longer. A Bloomberg report says that last year, investors pocketed nearly $900 billion in annual interest from US government debt. This is double the average over the previous decade. That's set to rise as over 90% of treasuries carry coupons of 4% or more. In mid 2020, says Bloomberg, just 5% yielded that much. Now, US treasuries are obviously held by many people, including countries. So you can imagine how people are earning from US interest rate bonds world over. So while we wait for more capital flows into the stock markets, including in India, and more on that later in the show, debt is doing well on Wall Street. Brent crude has moved up a little and is now quoting under $84 a barrel, and now specifically at $83.52, even as it appears that hopes for near-term peace in the Middle East is fading once again. Oil prices have been up and down now, given the tensions in the Middle East, but it could have been worse were it not for lower demand levels, particularly in the United States and other places. The Reserve Bank of India's crackdowns are beginning to tell. Banks and non-bank finance companies are beginning to pay the price for their excesses. Kotak Bank said the other day business impact would not be so much, but the reputation impact would be higher. In some ways, that statement came true because the stock market did send the Kotak Bank stock up on the basis or expectation of better performance. But for IIFL Finance, also Mumbai-based and a non-bank finance company, the news is not so good. It's reportedly facing a liquidity crunch because banks have turned cautious while lending to it, according to Reuters. This follows a clampdown on IIFL's gold loan business, the Wire agency has reported. An official at the company reportedly said that banks are neither sanctioning new lines of credit nor dispersing from already sanctioned limits, and the overall impact on business is likely to be around 500 crore rupees or about $60 million. 2 months ago, the Reserve Bank of India asked IIFL Finance to stop sanctioning, dispersing, and selling gold loans, citing material supervisory concerns in its gold loan portfolio. Soon after the curbs, IIFL Finance cancelled a proposed $400 million bond fundraising plan, though it's been raising funds, including $200 million from its main shareholder Fairfax, another 500 crore through bonds, and another 1,200 crore through a rights issue, said Reuters. Banks, on the other hand, told Reuters that they were in a wait-and-watch mode and waiting for the regulatory dust to settle. Some more than 50% of IIFL's total borrowing as of December last year was from banks. Now, IIFL's situation is interesting because lending freezes usually have domino effects, the kind of which, to be fair, we've seen before. Now, in the case of Kotak Bank, you could argue the impact is limited because its deposit-taking ability is not fundamentally affected. Remember, it's been asked to stop opening new accounts digitally and, of course, asked to stop issuing new credit cards. But a non-bank finance company borrows from banks, among others, and then lends to retail customers, usually in the form of many products, including gold loans, as in this case. So one can only hope that there is no downstream impact of these freezes, and banks and non-bank finance companies are careful about not falling afoul of Reserve Bank of India regulations in future. Australian farmers benefit from India's demand. Australian farmers have India to be grateful to after India, the world's largest consumer of pulses, removed import duties on some varieties of pulses in an effort to control food inflation, according to Bloomberg. The government scrapped duties on chickpeas or chana dal and extended tax-free imports of yellow peas, according to a weekend notification from the government. Pulses are a key source of protein for many in India, and other forms of pulses are imported as well. However, the interesting thing is that this decision could benefit drought-hit farmers in Australia, a leading exporter of that commodity where sowing is underway. Moreover, some farmers there are planting chickpeas instead of wheat due to ongoing dry conditions and in anticipation of higher demand from India, the commodity broker told Bloomberg. India imports pulses from many countries, including Canada and Myanmar. Retail prices for chickpeas were about 20% higher than a year earlier in Delhi on Sunday, according to the data from the Food Ministry. Earlier, the government lifted a ban on onion exports and imposed a duty of 40% on overseas shipments of onions. A ban obviously hurts farmers as they can't get the best price for their produce by exporting it, but a high duty could be a midway point of sorts if that level of duty is conducive to international buyers. Fear, apprehension, and optimism rule the markets. A month ahead of the election results, there could obviously be some doubts on the most foregone of foregone conclusions. The market has already priced in a BJP return to power, but it is but natural that there would be some jitteriness, which of course has arguably been introduced and transmitted by the BJP itself as it aims for a peak showing in these 2024 elections. Putting that aside, the markets are at peak valuations, as are so many stocks. So, at a time like this, ahead of an event like the election results, how should one be thinking of the stock markets and one's investments? And what are the strategies that work best or are best time tested? I reached out to Gautam Kalia, Senior Vice President and Head of the Wealth Management Platform Super Investor at Sharekhan by BNP Paribas. And I began by asking him how he was viewing this interesting conflict, perhaps, of apprehension at one end and, of course, optimism on the other when it comes to investing in the markets.
So yes, definitely it is a time when we see a lot of people who are on tenterhooks. They want to take some action in their portfolio, either play it a little bit defensive or maybe go all out and be a little bit more aggressive, depending on their view on the election outcome. But definitely it's a time where people like to make some change in their portfolio in anticipation of what they expect will happen. As far as the market is concerned, I think the market has to a large extent priced in, the BJP win. And we obviously see FIs have been staying out for some time. They are, in fact, not the ones who are really putting in the money. You see a lot of money that is coming in from the DIIs and, more importantly, the MF industry, especially with the retail participation going up month on month. So that money is really coming in, and that's providing immense support to the growth of the market. This is a time where your advisor becomes even more important to kind of remind you not to give into that action bias and just stay invested. Over longer term periods, obviously, we've noticed that the elections and the results turn out to be a non-event in the larger scheme of things. It's 1 month before, 1 month after really doesn't really matter.
Right. And that's a useful point because, I mean, over time, I guess if the markets are fundamentally, strong and companies are doing well and earnings growth is strong, that's going to matter. So, which brings me to the valuation question. So, at this point of time, again, the other aspect to my previous question is really that, yes, there's apprehension, there's optimism, there's fear and all of that. And the valuations are also at an all-time high. Where could we go from here?
The levels are at an all-time high. That I agree with you. And that is definitely a concern for anyone trying to put in large, let's say, lump sum investments now. But as far as valuations are concerned, at Sharekhan, we are looking at the valuations and we don't see any elevation. We don't really see any stress. If we look at the trailing PE, it's 22.6 times versus the trailing PE, let's say, in October 21, where it was 28.2 times of the Nifty. And if we look at the 1 year forward PE chart of Nifty or 1 year forward PE chart of Sensex, they are only marginally above their average. So Nifty is trading at 22.9 times FY24 earnings and 20.1 time of FY25 expected earnings, which is really a modest premium, when we look at average multiples. So as far as valuations are concerned, we don't see a stretch. Valuations could be a concern if earnings growth wasn't there, but we see strong earnings growth. Maybe the IT sector has not done so well, but otherwise strong earnings growth all through across different sectors. So really, we don't see valuation still being stretched, and we are very comfortable in telling our aggressive customers to go 100% allocation to the equity asset class.
Right. And is the price to earnings ratio the key factor that you look at, for example? I mean, how do you, let's say, feel assured or reassured when you look at numbers going up and down? And I'm talking about the Sensex or the Nifty, or when people ask questions.
Yeah, so obviously in valuation, we look at other metrics also. These were numbers that were readily available at the top of my head, but obviously we look at EPS as well and other valuation metrics. But across valuation metrics, we don't see any stress. Yes, we do see, let's say, pushback from clients when it comes to the market reaching an all-time high. And, the levels themselves look daunting to the clients. But it's our job to remind them that the market is going to continue to make all-time highs in its journey towards growing, and 150,000, for example, is not too far. In fact, I remember 3 years back in a media interview, I had said that we'll reach 1 lakh BSE. So, but these things are only par for the course in terms of a growing economy like India, that is where the GDP expected is at least 6% plus. Consensus estimates put GDP growth rate at 6.2, 6.3 going forward. And obviously, if we take into account inflation as well at another 5% there, so you're looking at 11, 12% growth in nominal terms. So obviously, most of that growth is coming from corporate India, which is represented by the listed market.
Right. You were telling me earlier that 60% to 70% of your clients' money is in mutual funds. Now, how are you seeing the mutual fund universe, and what are you telling your clients to, or how are you telling them to invest, and how are you selecting or the mutual funds, again, broadly at this time, but even in general?
I hate to sound boring. I would love to give you a very exciting answer to this, but really I'm doing the same thing that I was doing 10, 20 years back. And basically reminding clients of the principles, not to try to time the market, try to stay as long as possible, make sure that they follow a appropriate asset allocation strategy. And these are foundational principles in any conversations. Besides that, what we do try to do is bring in a little bit of alpha generating opportunities through, let's say, selecting key fund managers who are, let's say, offering products on the portfolio management scheme, PMS platform, or the alternative investment fund space. So that is one place where we do add value. And the other place, obviously, where we add value is within the mutual fund space, where we follow a core and satellite approach, where while your core portfolio is the stable long-term portfolio, but we try to add, let's say, thematic funds or sector funds to kind of bolster your overall return. So for example, just ICICI Prudential Manufacturing Fund is something that is one of those thematic funds that we talk about because of the emphasis on manufacturing. We see that real estate also is expected to do very well and contribute to maybe 2 times the growth rate of India's GDP over the next 5 to 10 years. So we see manufacturing, real estate, logistics, these sectors and these themes kind of play out. So those kind of funds are additions that we suggest to the client's portfolio.
Last question, Gautam. So you also look at behavior again, which in a way comes or brings me back to my first question. So, which is, how should or how will people react, and what would be your, let's say, your advice to those who are maybe waiting on the sidelines?
Fantastic question. I always find this interesting because every time I meet a new investor, they typically end up asking the same questions. And the questions that they ask have literally no bearing on their wealth creation. And that's really what I find fascinating, that we end up obsessing about information that is not really important to us. Studies upon studies have shown that the best time to start investing is when you have the money. It doesn't really matter regarding the market level. And especially in I would say, a economy like India, where we've seen, I won't say a steady state, but we've seen an upward trending economy for the last 20, 30 years. If you look at the index also, it's given 16, 17% CAGR return since inception. So really, even if you make a plan at 12% and you start investing, you shouldn't really get bogged down by, let's say, if there is a war happening or, the elections are taking place. Those are things that people use as excuses because you think that, okay, maybe if you apply yourself, you'll probably be able to generate higher returns, but that's generally not how it works. When you look at R squared analysis, you see that it comes down to the corporate earnings. The market really is a slave to corporate earnings. And that's really the key number that matters. So what we end up telling clients is just build a portfolio, build asset allocation, don't take too much risk. So if you don't lose money, that's a fantastic first step. If you follow asset allocation principles, and the key insight is about trying to make people understand that when they're investing in the equity market, they should expect to lose 20 to 30% of their capital. So when you go in with that mindset, then you're already prepared to see your portfolio in the red. And if it doesn't happen, that's a big plus. But if it does happen, at least you're mentally prepared for it and you don't end up making mistakes that most new investors make, which is what they invest. They take too much risk that then they're comfortable with. They don't know what they're doing. They see that loss and then they exit at a loss and then they never come back. So that's something that we help people avoid doing.
Very useful, Gautam, particularly at this time. Thank you so much for joining me.
Thanks a lot.
India's airlines set to capture more international traffic. India's airlines are set to soar in the international market, capturing a significant share of passenger traffic in coming years, according to a new report by CRISIL Ratings, which predicts that Indian carriers will hold nearly 50% of the Indian international passenger traffic, which actually, if you look at what numbers are right now, is a substantial increase because right now, Indian carriers hold a 43%. So, roughly 43 to 50% in about 5 years. That was the core report with me, Govindraj Ethiraj. Do stay connected with more of our coverage at the core. You can check out our website or sign up to our newsletter for our exclusive stories, one in-depth feature a day on www.thecore.in. Do also track us on LinkedIn, where we usually post synopses or extracts of our top stories and interviews. We would love your feedback on how we can make business more interesting and relevant, including, of course, India's vibrant manufacturing sector. So write to us at feedback@thecore.in, and thank you once again for listening.